So what is up with limit up, limit down? Today we had problems with NEE and AEP. Apparently these stocks right after the open cratered and came back. Last week we had a problem with Anadarko, same kind of problem except it was on the close. What's going on? That's the question I'm here to pose to Rich Steiner. Rich is the head of U.S. Market Structure Strategy at Royal Bank of Canada Capital Markets, RBC Capital Markets. And I guess that's my question. What happened? First of all, what happened with NEE and AEP today?
So today, NEE and AEP, both utility companies, had their stocks halved basically between 9:30 and 9:31 as sell orders hit, and on the New York Stock Exchange you had some very, very low priced trades.
I thought we had limit up, limit down. How come limit up, limit down didn't catch this stuff?
Limit up, limit down is in phase one currently, and in phase one, in the stocks that are in the limit up, limit down program, the actual strategy of limit up, limit down does not take effect in the first 15 minutes of trading until 9:45, and also it stops at 3:30, so the last half hour of trading. So ironically, the most volatile times in the marketplace are the open and close.
Times with most volume.
And most volume, right? Don't have any collars because when limit up, limit down went in, we've now removed the circuit breaker functionality. So either stocks have circuit breakers or limit up, limit down. The concern here is that with limit up, limit down, around those times that it's not in effect, from 9:30 to 9:45 and the last half hour from 3:30 to 4, we can run into these vacuums.
So let's take the morning and the afternoon out of this. During the day, has limit up, limit down been working okay? Have we had a number of folks bounce against the limits and kind of go back, or should we just throw limit up, limit down out and go back to circuit breakers?
It's a good question. We've had, most of the limit up, limit down situations have been from a straddle state, or basically, stocks that are illiquid, they don't trade much, and that are really quote-driven activity is causing them to be in a limit state. Since they trade very infrequently, it stays in a limit state for 15 seconds, and you end up with a halt. Not really what limit up, limit down was intended to do. Limit up, limit down is based on stock price. Maybe a modification could be to base the percentage move to trigger a limit up, limit down halt on the average daily volume. So maybe stretch it out for less liquid stocks. But as it stands right now, that's not the case. Although we've had a number of instances where individual stocks did run into limit up, limit down, and it appears that it worked right. For instance, MBIA on the New York Stock Exchange hit three halts, 2 on the upside and 1 on the downside, and it did appear to work as intended.
Okay.
Yeah.
So is this just a case that for Anadarko and NEE and AEP, these are just kind of outliers in this weird, funky time of we're struggling to get this stuff in, or is this something more serious that we have to look at?
Well, we certainly hope that these are aberrations and they're really unintended consequences from a rule that was brought in a phased approach, which generally we think makes sense, so that market participants have a bit of time to acclimate to the full rule. But as a result, we've got this situation now where Anadarko and AEP and NEE in recent history have been negatively impacted. So when limit up, limit down in phase 2, which starts August 1st, the rollout, we're
going to extend it.
Yeah, we do think it'll work.
Good.
When we've seen it work intraday, it's worked properly.
Good. So that brings us to me another question: is how come we're seeing all these air pockets or vacuums or whatever? Is this an issue? It's just that a lot of the market makers and a lot of the taking and providing strategies have become so fast and so good. They're only providing a very thin veil of liquidity at the touch, basically, as they say in the UK. And then once you get past it, there's not a whole lot of retail flow. There's not a whole lot of limit orders kind of up and down the stack. Or is this just high frequency trading problem?
It's likely just an outgrowth of the market structure that has evolved, between rules banning stub quotes. So you've gotten some orders off the books that are far away. And again, these are big moves. 50% moves are meaningful. Anadarko trading down from $90 to a penny in well less than a second. That's more than likely part of it. I think to your point, market makers trying to minimize risk. If they get hit down 5, 10, 15%, they have to wonder, where did that come from? How do you really properly process that kind of risk and getting a very away from the current market execution? So it's probably an evolution, and then broker algorithms really trying to, if you will, mimic what the marketplace is doing to not stick out. Again, don't want to be the only ones out there posting limit orders away.
And to a certain extent, I guess the general public has kind of been aware since the flash crash of their stop losses being triggered. So to a certain extent, I'm not sure that they want these outside quotes, limit orders or stop losses or whatever.
It's a great point. More than likely, yeah. Certainly when you see these vacuums, I mean, obviously we're concerned about investor confidence and market integrity, and we are working with regulators and policymakers to make for a better market structure. But these vacuums, are something that we're sure that the regulators are looking into.
What do we think should be done, or just kind of hold out till the August 1 phase 2?
At this point, we're probably in this limbo state until August 1st when the rollout goes, and through a bit of September as well. But hopefully, we're supportive of a holistic review of the market structure, and we're also supportive of pilot studies in the interim to address certain inefficiencies and things where we feel transparency can be increased.
What are some of those pilot studies that you would like to see in the market?
One of the concerns we have is maker-taker pricing. I think a lot of things revolve around that. So proposing a pilot study to eliminate maker-taker, and then we would have the data. Mm-hmm. The regulators would have the data, academics, market participants would have the data to then analyze what are the effects.
What are these abnormalities being created by the maker-taker incentives? Mm-hmm.
Exactly.
So when you think about a pilot study like that, would you pick 50 stocks or 100 stocks and just say, or pick a market, say, ABC market, you're going to just, we're going to try you non-maker taker?
We'd probably look for a few hundred stocks across market caps, except for, we talk about small cap, mid cap, large cap, nothing in the micro cap space, things that trade, and we can have some data. We'd expect it to run for at least a year, so people do a proper build out for it.
So we can actually have some data to analyze.
Exactly. And we're confident that we would see, improved transparency, reduced conflicts, more efficient markets, and the data would be there to support it. And ultimately, it's a scaled-in approach. Right? We're not talking about skydiving without a parachute.
Right.
And so that's one of the advantages that we think pilot studies bring.
Interesting. Well, that I think we'll bring it to a close. I want to thank Rich Steiner, head of U.S. Market Structure Strategy for RBC Capital Markets. Thank you for joining me. I'm Larry Tabb, founder and CEO of Tabb Group. Thanks.